here's an example that I use in my introductory finance class. I'll describe it very briefly because I think it'll be pretty obvious. Suppose you're thinking about buying a piece of equipment, a DNA sequencer, and it costs $1 million and it lasts 10 years. And if you've got this DNA sequencer, you can use it to generate various kinds of assays that will bring you $300,000 a year in revenues, but it'll cost you $100,000 a year to operate the sequencer. Okay? So if you assume that this piece of equipment is depreciated over 10 years, so depreciation is an accounting concept. It's a measure of how a particular durable purchase gets used up. So in the accounting fiction, we're going to assume that this $1 million piece of equipment evaporates 1/10 every year. So we're using it up little by little over time. Of course, that's not really how it works. You have to spend $1 million right now, and then you get that equipment, and it lasts for as long as it lasts. But the accountants have to come up with a particular schedule to be able to allocate that expense across multiple years. What this means is that the current kind of earnings that we measure as an accountant is not the same as the cash that comes in and out of the door at the end of every year for the firm. And what matters for the purpose of capital budgeting and financing is the amount of cash that comes into and out of the door. So I'll explain why in a minute, but before I do that, let me just illustrate to you how that works in this case. So on the left-hand column is the accounting earnings before interest and taxes. And that looks like this: $300,000, which is your revenues, minus $100,000, which is your expenses, and minus the amount of the machine that you've used up at the end of the year, which is 1/10 of a million or 100,000. So according to the accountants, you just earned $100,000 in year one. And in fact, you go down the list, this is your earnings for all 10 years. 100, 100, 100, 100. That's what accountants say this company has earned. If you're sitting at the company coffers watching money going in and out, that's not what you see. What you see from the cash flow perspective is your first year, you've got $1 million that you've spent in year zero. And then, starting in year one, you earn $300,000, and you pay $100,000 in operating costs. Then you got to pay taxes on that. And then you get $40,000. Where'd that come from? Where'd you get the $40,000 from? Somebody give you a gift? Well, sort of.
Depreciation.
Exactly. It's a depreciation gift. Actually, it's the government saying, you get to deduct depreciation, and so we're going to just take that off of your taxes. That's how much you save in taxes. It's a depreciation tax shield. That's real. That's money that you actually have in your bank account that you wouldn't have had if you didn't do that straight line depreciation. So accounting does have an impact on cash flows. It's not that you can ignore accounting. Accounting is actually quite important, but it doesn't have the same effect as accounting variables. Okay, so now you've got $40,000 of depreciation tax shields, which means that the amount of money you're earning in years 1 through 10 is not 100, it's 160,000. So when you calculate the net cash flows and take the present value, you get a very different number than when you calculate accounting earnings. And now I want to just mention briefly why it is that we care more about the right-hand column than about the left-hand column. The accounting earnings are obviously important for a lot of reasons, but for making decisions, net cash flows are critical. And the reason is because of all of you. How do we price various different investment opportunities? Anybody? Do you remember? How do we figure out what something is worth? If we don't know anything about present value and NPV and all these calculations, how do you figure out what something is worth? How do we figure out what the brown bag was worth in the first day of class? Yeah?
Wisdom of crowds.
Exactly. The wisdom of crowds. Basically, we put it up for auction, and people will bid on it. And what will people bid on? Are they going to bid on accounting earnings? What people care about is cash coming in and coming out. It's the wisdom of crowds that ultimately values these various different projects. So if you are trying to do your best to maximize shareholder wealth, you have to focus on the thing that the market cares about most. Now, it's not to say that accounting earnings are unimportant. There are all sorts of games you can play with accounting earnings that will make a company look more or less attractive. In some cases, the attraction is real because you're generating tax shields or other benefits. In other cases, it's what are called optics. You're making it look better than it really is, but it matters for various behavioral reasons. But the point is that ultimately, we are doing this. We are focusing on net cash flows because that's what the market, the wisdom of crowds, all of you value. When you take a look at a series of cash flows that really look attractive, you're going to pay more for it. Our objective is to maximize shareholder wealth, so we're going to be focusing on that.